Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me back.
So today we are taking a deep dive into something that I think a lot of people in the West completely misunderstand. There's this pervasive myth right now that when it comes to dominating the future of tech-like artificial intelligence and semiconductors, that China is just, turning on the printing presses and handing blank checks to startups.
Right, the idea that they're just brute forcing innovation with limitless cash.
Exactly. And the assumption is that they are totally ignoring their everyday citizens in the process. But when you look at the recent data, the reality of how they are actually funding this tech boom is, well, it's far more complex. It's frankly brilliant in its engineering and has massive direct implications for your wallet as an American investor.
It really does.
Yeah.
It's a fascinating mechanism to trace, mostly because it completely upends how we traditionally think about capital allocation here in the U.S.
Yeah.
If you want to understand the competitive pressures facing global markets right now, you really have to understand the specific financial architecture they're using to build their tech sector.
Okay, let's unpack this because right now, borrowing money in China is incredibly cheap. I mean, the one-year loan prime rate is sitting at 3.0%.
Which is very low.
Yeah. And the initial instinct for an outside observer is to look at those rock-bottom rates and assume, oh, this is just a masterstroke of government planning, that Beijing just decided to make money cheap so their tech sector could outcompete everyone else. But based on the macroeconomic data we have, that doesn't seem to be the whole story, right? Are these rates purely a strategic choice?
Not at all. I mean, you really cannot understand their current interest rate environment without looking at the severe domestic headwinds they're facing right now.
Right.
They're dealing with a profound economic hangover. When you examine the raw output, the weakness in their domestic market is glaring. So the official 2026 growth targets were set pretty optimistically at 4.5 to 5.0%. But Q2 2026 growth actually slipped to 4.3%, which is the lowest we've seen in 3.5 years.
Wow. And the consumer side looks even more frozen. I was looking at the retail sales for July 2026, and they grew by a microscopic 0.6%.
Yeah, barely moving.
Barely moving at all. Combine that with a record drop in new loans by 340 billion yuan, and it paints a picture of a population that has completely stopped borrowing and spending. The analogy that comes to mind for an everyday American listener is it's like a massive shopping mall that just lost its anchor tenant.
Oh, that's a great way to put it.
Right, because for decades, the real estate sector was the giant department store. It was driving all the foot traffic, taking out all the massive loans. But now that the real estate market has collapsed, that anchor tenant has packed up and left.
Exactly.
The rest of the mall is sitting empty, and none of the smaller stores are asking the bank for expansion loans because, well, nobody is walking through the doors.
That captures the dynamic perfectly. Because that anchor tenant left, the banks suddenly have this massive void where their primary lending business used to be. Historically, property developers and home buyers, they were the ultimate sponges for credit in China.
And now the sponge is dry.
Completely dried up. And everyday households are actively trying to pay down their existing debts rather than take on new ones. So borrowing demand has plummeted, and consequently, those low interest rates aren't just the central bank, the PBOC artificially forcing rates down just to be clever.
Right, it's just basic supply and demand. The banks have money, but since nobody wants to borrow it, the price of that money, the interest rate, naturally falls.
Yes, exactly. And it's compounded by deflationary expectations. I mean, if you as a consumer believe that prices for goods or even houses are going to be cheaper in 6 months, you delay your spending today.
Which makes total sense.
Right. But it creates a vicious cycle that further depresses demand for loans. Plus, foreign investors have been buying up Chinese bonds as a bizarre sort of safe haven, which pushes long-term yields down even further. So the environment is naturally yielding these low rates.
Which raises the billion-dollar question. If everyday consumers aren't borrowing and the massive property developers aren't borrowing, where is all this cheap capital actually flowing?
Right.
Because the money supply hasn't just evaporated, it has to be moving somewhere.
This is where the state intervenes, and they do it through something called a structural credit policy. Rather than using broad tools like dropping interest rates to zero for everyone, which is, what the U.S. Federal Reserve might do in a crisis, the central bank uses engineered routing.
Engineered routing.
They actively direct this pool of cheap, idle capital into very specific strategic industries. We're talking artificial intelligence, advanced robotics, green energy, and semiconductors.
And the scale of this routing is just staggering. Based on recent analysis in early 2026, the central bank expanded its tech relending program to 1.2 trillion yuan, which for our U.S. listeners translates to roughly $170 billion, entirely earmarked for tech and innovation.
It's a massive influx of capital.
But let's clarify the mechanics of this, because I think this is where the Western misconception really takes hold. The central bank isn't just cutting a check at 1% interest to a couple of guys building an AI startup in Shenzhen, right?
No, not at all. It is a highly orchestrated two-step process that uses the existing commercial banks. The central bank doesn't evaluate tech startups or issue direct corporate loans. Instead, they approach commercial banks and offer them funds at a remarkably low rate, around 1.25%.
Wow, 1.25%.
Yeah, but there's a strict condition attached to this liquidity.
The catch is that the commercial banks are only allowed to access these ultra-cheap funds if they immediately turn around and lend them to a pre-approved list of qualified tech companies.
Precisely. So the commercial bank takes that 1.25% money, they add a very thin margin just to cover their operational costs and basic risk, and then they issue the loan to, say, a semiconductor manufacturer or an AI data center developer.
Okay.
The final rate the tech company receives depends on their individual credit profile, but the foundation of that loan is deeply subsidized by the central bank's initial rate.
I mean, it is essentially a state-sponsored, friends and family subsidized mortgage for the tech sector.
That's exactly what it is.
And to really understand the advantage here, we have to contrast this with the reality facing an American investor or tech company right now. Because, if a U.S. company wants to build a state-of-the-art AI data center today, they are at the mercy of free market interest rates.
Oh, absolutely.
As of August 2026, the 30-year U.S. Treasury is hovering above 5.3%. And corporate borrowing costs are significantly higher than that. So an American tech firm has to prove to Wall Street that their AI investment will generate massive immediate profits just to justify the cost of borrowing the money to build it.
Right. The burden of proof for profitability in the U.S. model is immediate, heavy, and totally unforgiving. By artificially suppressing borrowing costs for their tech sector, China is fundamentally altering the cost of capital, or WACC, the weighted average cost of capital, for these specific industries.
Right, and for our beginner investors out there, by lowering that WACC, you are basically lowering the hurdle a company has to jump over to be considered a success.
That is the core mechanism. Every business project has a hurdle rate. If your cost of capital is 8%, your new project has to generate at least a 9% return just to keep the lights on.
Makes sense.
But by stepping in and providing this structural credit, the Chinese government is lowering that hurdle to the floor. And it's not just these targeted commercial bank loans either. It's a layered approach. A tech firm might secure this subsidized loan and then layer on local municipal government subsidies and then get equity injections from state-backed investment funds.
Oh, wow. So they just stack them.
Exactly. When you aggregate all of these capital sources, it acts as a massive quasi-subsidy that essentially insulates the company from the pressures of immediate profitability.
They're building a financial shield around their strategic sectors. They can afford to build massive server farms, run endless iterations of language models, and, research next-generation chips, even if they don't see a dime of positive cash flow for a decade.
Yeah.
But wait, this brings up a massive structural vulnerability. If I am a commercial bank, and the central bank is forcing me to take money at 1.25% and lend it to an AI company at, say, 2%, I am making an incredibly thin margin.
Very thin.
That sounds like a fast track to insolvency for the banking sector. I mean, who is actually absorbing the financial penalty of providing these VIP mortgages? Because the money isn't free.
You've just identified the most fragile, load-bearing pillar of this entire economic strategy. In any financial system, when money is artificially cheap for one group, someone else has to absorb the real cost.
There's no free lunch.
There is no free lunch. In this architecture, the entities paying the bill are the commercial banks themselves and ultimately the everyday Chinese saver.
And the banking data really highlights the strain here. We measure a bank's core profitability by its net interest margin, which is just the difference between the interest they pay out to people holding savings accounts and the interest they collect from the loans they issue.
Right.
In Q2 2026, Chinese bank net interest margins collapsed to a dangerously low 1.41%.
That margin is razor thin, and it's a huge systemic risk. Banks need a healthy net interest margin to build up capital buffers. If a percentage of those tech loans go bad, and in high-risk sectors like AI, many of them absolutely will, the bank needs a cushion of profits to absorb those losses without going bankrupt.
Yeah.
At 1.41%, that cushion is virtually non-existent. They're operating dangerously close to the edge.
Which explains a bizarre regulatory crackdown I saw in the data regarding something called manual interest compensation. Because if the banks are this desperate for breathing room, they need massive deposits to fund their operations. But the government strictly caps the amount of interest a bank is legally allowed to pay you on your savings account, right?
Yes, the government enforces a ceiling on deposit rates. So the commercial banks found themselves trapped. They were mandated to issue these low-yield loans to tech companies, but they couldn't legally offer high enough interest rates to attract the massive corporate deposits they needed to balance their books.
So what did they do? Did they just break the rules?
Essentially, yeah. They created a secret, off-the-books menu for their biggest clients. They engaged in manual interest compensation, which meant they were secretly manually paying extra cash or providing off-book financial perks to large corporate depositors just to win their business.
Oh, wow.
They were intentionally breaking the rules just to survive the squeeze. When the central bank discovered how widespread this was, they initiated a massive crackdown. They had to stop it because by secretly paying higher rates for deposits, the banks were driving up their own costs, which threatened to defeat the entire purpose of the cheap money tech policy.
Wait, hold on. If the central bank is cracking down on the one-trick banks we're using to survive, and these banks are operating on a microscopic 1.41% margin while taking on all this high-risk tech debt, why aren't we seeing cascading bank failures? Why hasn't a major state bank simply collapsed under the weight of this?
Because the state refuses to let them fail. They act as the ultimate shock absorber. The government is fully aware that their structural credit policy is bleeding the banks dry. So to prevent a systemic collapse, the state simply steps in and recapitalizes them.
Ah.
Based on recent analysis, the Chinese government injected $72 billion directly into large state banks in 2025, and they're preparing to inject another 300 billion yuan in 2026.
That is wild. They force the banks to make unprofitable loans to tech companies, bleed the banks to the brink of failure, and then just bail them out with taxpayer funds.
It is the textbook definition of financial repression. The state forces deposit rates down, effectively punishing the everyday citizen who is just trying to save for retirement or buy a home. Because inflation outpaces those capped deposit rates, everyday savers are earning negative real yields.
Ouch.
Yeah, this forces them to save even more of their income just to maintain their purchasing power, which further crushes domestic consumption. The cost of China's technological dominance is quite literally being extracted directly from the wealth of its middle class.
That is a staggering transfer of wealth from the consumer to the industrial base. Though, looking at the policy announcements, we should add a quick nuance check here. It isn't that Beijing has entirely abandoned the consumer in some cartoonish way.
No. It's important to look at the complete picture. The data does show efforts to address consumer strain. They recently designated 500 billion yuan in specific programs for elder care and consumer services, attempting to stimulate some domestic demand.
Right. But when you weigh that 500 billion against the multi-trillion yuan facilities dedicated to tech, manufacturing, and bank bailouts, the structural tilt is undeniable. It's like a parent buying their oldest child a brand new, fully loaded sports car and buying the youngest a bicycle.
Exactly.
Yes, they both received a vehicle, but the priority of investment is glaringly obvious.
The leadership firmly believes that long-term geopolitical and economic power stems from dominating the supply side of the global economy, controlling the manufacturing, the AI infrastructure, the semiconductor foundries, rather than cultivating a demand-side, consumption-driven economy like we have in the United States.
So what does this all mean for the listener? Why does a deep dive into Chinese net interest margins and structural credit policies matter to an American investor? It matters because this internal mechanism does not stay within China's borders. It bleeds directly into the global markets, and it fundamentally alters the competitive landscape. With President Trump currently in the White House, we know that U.S.-China trade dynamics, tariffs, and protecting American manufacturing are massive focuses.
Exactly. Understanding this financial repression mechanism completely reframes the narrative around U.S.-China competition.
Yeah, because when an American company goes toe-to-toe with the Chinese competitor, they aren't just competing on engineering or product design or marketing. Because of this structural credit, the American company is forced to compete against the sovereign financial resources of an entire nation.
And that dynamic creates a brutal, hyper-competitive gladiator arena inside China's domestic market.
A gladiator arena.
Yes, because capital is so artificially cheap and abundant, you don't just get 3 or 4 companies trying to innovate in a new sector. You get 100 different companies, all heavily subsidized, all building the exact same type of legacy semiconductor or the exact same solar panel architecture.
And because of that VIP mortgage we talked about, they can survive for years while operating at a massive loss. I mean, if an American solar company runs at a severe loss for 3 years, Wall Street crushes their stock, the board fires the CEO, and they eventually file for bankruptcy. The free market enforces discipline.
Right.
But a Chinese firm backed by state-mandated bank loans just keeps the assembly lines running.
Which leads to the most disruptive economic consequence for the global market: severe overcapacity. When you have 100 companies surviving on cheap debt, relentlessly producing goods that they cannot possibly sell to their own domestic consumers, because as we discussed, the Chinese consumer is trapped in financial repression and isn't spending, what do they do with all that excess inventory?
They have to export it.
Yes. They flood the global market with incredibly cheap solar panels, electric vehicles, and legacy chips. By doing this, they're effectively exporting their own domestic deflation to the rest of the world.
So if you, our listener, are holding stock in a U.S. green energy firm or a European auto manufacturer, your portfolio is directly feeling the downward pressure of those Chinese tech loans. The subsidized Chinese companies can afford to slash prices and sell at a loss just to capture global market share, and your American companies simply cannot afford to match them.
This raises an important question, however. On paper, it sounds like China has engineered an unbeatable cheat code for dominating global industries. But structurally, it's an incredibly high-stakes, dangerous gamble.
Wait, why is it a gamble? I mean, from a competitive standpoint, having access to bottomless, cheap capital seems like an insurmountable advantage.
Because of what inevitably happens when you strip market discipline out of an economy. In a normal interest rate environment, capital is expensive, which means bad ideas die quickly. Investors demand returns, and if a project isn't viable, they pull the plug.
Right.
But when capital is practically free and backed by state mandates, bad ideas can live for a very, very long time.
So you end up with an economy full of zombie companies.
Precisely. This strategy guarantees the creation of thousands of zombie companies and immense mountains of bad, non-performing debt within the Chinese banking sector. The state's thesis is essentially substituting capital efficiency, getting a high return on a small investment, with sheer scale and extreme patience.
Right.
They operate on the assumption that if they throw cheap capital at 1,000 AI startups, 999 of them might burn through billions and fail, but the one that survives will achieve a dominant global monopoly.
It's the Silicon Valley venture capital model, but executed at a macroeconomic level, using the nation's entire commercial banking system and the savings of its citizens as the collateral. The scale of the risk is breathtaking. If those investments in AI and next-generation semiconductors don't eventually yield real, globally competitive breakthroughs that generate massive revenue, the accumulated debt will eventually crush their financial system.
It is a profound vulnerability. And for the global investor, this completely changes how you evaluate international competition. When you see a Chinese competitor offering a product at a price that seems impossibly low, you have to recognize that you aren't necessarily witnessing superior engineering, better supply chain management, or more efficient labor. You're often just looking at the mathematical result of a heavily subsidized cost of capital.
Which explains why global trade friction, the tariffs, the export controls, the intense political rhetoric we are seeing right now isn't just temporary political theater. It is a structural, unavoidable reaction to two completely incompatible financial models colliding in the same global marketplace.
It's a fundamental clash of systems. The West allocates capital based on near-term risk and reward, enforced by the free market. China is currently allocating capital based on long-term strategic dominance, enforced by state mandates, and funded by financial repression.
We have covered incredible ground today. We've traced how a crippling real estate hangover created the initial environment for cheap money. We examined the precise two-step mechanism the central bank uses to force commercial banks to issue VIP mortgages to the tech sector.
Yeah.
We unpacked the secret squeeze, revealing how the everyday saver is unwittingly funding this transition through suppressed interest rates and bank bailouts. And we've mapped out how this internal strategy creates a gladiator arena of overcapacity that ultimately floods the global market, directly challenging American companies and forcing aggressive trade policies.
It's a masterclass in macroeconomic engineering, but one built on an increasingly fragile foundation of debt and suppressed consumption.
They are essentially using their entire banking system as a shield to protect their tech industries from the harsh realities of the free market, buying them years of runway to figure out how to be profitable. But here's a final provocative thought to mull over as you review your own portfolio. In a sector like artificial intelligence, where the underlying technology and hardware are evolving by the week, does having the patience and the limitless capital to fund a 5-year development project even matter if the technology you are building becomes completely obsolete in 6 months? Is China's greatest engineered advantage patient capital actually a massive trap in the hyper-fast-moving age of AI?
That is the multi-trillion-dollar question, and the answer will likely determine the shape of the global economy for the next decade.
It really is. Something to think about as you watch the markets this week. Don't forget to subscribe and hit that like button.